You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Wednesday. Time to rock out once again with a little bit of options education. Yes, it is time once again for Options Bootcamp, what the cool kids call OBC. My name, of course, Mark Longo from theoptionsinsider.com, as well as on the network upon which so many of you folks are binging. If you're hanging out in the pro, you enjoyed a super-sized pro Q&A yesterday with our good buddy, the last emperor himself from Fidelity over there. He took down all comers. We went extra long, tackling all kinds of questions. If you're on the pro side, you hang out in the chat, you missed it. You missed a good one. Head on over to the pro, theoptionsinsider.com/pro to get access to it. Of course, if you're not on the pro, what are you doing? You're missing out on cool stuff like that. Options oddities, exclusive giveaways, all kinds of fun live streams. Check it out. It's a good time. Theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us on the old program today, I am pleased to be joined once again on Education Wednesday by my educational partner in crime, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. What the cool kids call to him. Mr. P, welcome back to the show. You know, whenever I say the black-hatted one, I think of Heisenberg with his hat. You got one of those little Heisenberg hats floating around?
I do not. Maybe I should get one of those.
I think that'd be a good look for you. I think you should try it out. What do you think?
Yeah, why not?
Don't tell the wife. Just roll in one day rocking the Heisenberg hat. Sit down to dinner and then just see what she says.
You know what? She would not be fazed with the crazy shit I do all the time. Sorry about that.
I think that would be good. And speaking of crazy ass, I think we got some more in store for us, Dan. Let's get to a little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to the options drills, the portion of the show where we typically break down an options topic or technique or strategy, maybe some pro tips and tricks for how you can utilize options in your own portfolios. Lately, Dan, the options drills has been hijacked by one thing and one thing only. The folks can't get enough of the forgotten options terms. Here we were, we thought we were having a fun little dalliance for 5 or 10 minutes on one show. And the next thing we know, Dan, we are living in the forgotten options term universe. It's just our thing now. It's what we do, Dan. I hope you like it.
That sounds pretty good. Yeah.
It's our lot in life to talk forgotten terms until we finally shuffle off this mortal coil. And so we have had listeners submitting a bunch on the last show. We have more this time, Dan. A lot of them coming from one particular listener. It's like Dartharian is his handle. He says, hello to OBC. If you're still taking submissions for forgotten terms, well, we never technically were. We never put out a shingle said, send us your submissions. They just started coming in there. But hey, you know, we take them. We love your feedback on the show. He said, if you're still taking submissions for forgotten terms, I have a few for you. And he does. He cheated, though. He said, I took a moment to ask Chat GPT for their ideas for forgotten options trading terms. And he proceeds to send us, let's just say, a lengthy list courtesy of Chat GPT. So I'm of two minds on this, Mr. Dan. On the one hand, I love that our listeners are engaging with this and they're enjoying it, and that's all great. On the flip side, I don't like to condone just the handing off of your brain power to AI, which is why I mocked you for doing it on the show a few weeks ago. You know, we want to use our own gray matter whenever possible. But that said, he did go to the modicum of effort of typing this into Chat GPT. And it gives us a chance to rate the robots again, Dan. We can see how good the robots are at options. Are you ready for this, sir?
Yeah, let's do it. Let's do it.
All right. So according to our listener who submitted this, I don't know what his exact query was, but he submitted this to Chat GPT. This is what Chat GPT terms as underused or forgotten options trading terms. And there's quite a few here, Dan. It's like 30. So strap in. Here we go. All right, first up, this is one we've talked about on this very show. So I don't know if I would consider this forgotten. You can maybe give it underused. Remember when we talked about it and I was surprised at how heated the response was, Dan, to a pretty innocuous strategy, all things considered. The box spread, they're number one. I don't know if this is in any sort of order in terms of most to least forgotten. I think this is just the order the robots spit it out on, Dan. Number one is box spread. What do you think? You give that a yay or a nay, Dan?
Funny, but about 3 weeks ago, I went out to dinner with a colleague of mine.
Were you wearing your Heisenberg hat at the time?
I was not. And
you talked about box spreads over dinner. Well, you must be a scintillating dinner guest, sir.
It is true. It is true. She brought up box spreads and about how some traders that she knows are all about them and doing a fair amount of them lately, which I did think was kind of strange and unexpected. But yes, it did literally come up in conversation about 3 weeks ago.
Remind me to next time I'm invited to dinner at the Passarelli household to strategically decline, sir. All that hot box spread conversation. But you know, when we brought them up on the show, people wrote in with a lot of heated responses. So yeah, they are apparently still popular. So I think I might give the robots a demerit for that one. If you expand the search prompt to underused as well, then maybe that could fall into there. But forgotten, I think a lot of people know this one. Number two is actually interesting. I was thinking about this one myself. I was trying to debate whether this one merited inclusion. And the robots decided it did, Dan, which is conversion reversal. So obviously synthetics, we've talked about these before, listeners, but it's been a while. These are effectively synthetic underlying positions you put on using options. You're selling call, buying put, same strike to get short the underlying, buying call, selling put, same strike to get long the underlying. Usually it's done against the underlying itself, hence the term, the trade itself, a conversion or reversal is done with the underlying and either shorting or getting long the synthetic and then trying to capture that little bit of differential, that carry, taking advantage of your interest rate, whatever the case may be. Dan, I was kind of mulling this one over, so I might give points to the robots for this one, maybe a half point. What are your thoughts on conversion reversal, sir?
Oh, yeah. I mean, they're not terms that I use a lot these days. And I think well, yeah, I mean, part of it is because of my role now where I don't do conversions and reversals. I mean, down on the trading floor, I do them, at least right around expiration every time. But I don't even know if a lot of professional market makers are doing a ton of conversions and reversals. I definitely don't see a lot trading. Not as many as I recall trading myself when I was down on the trading floor when it was a different environment. So, yeah, I mean, I'll give I mean, I don't know if we have to give the robot a binary yes or no.
That's the language the robots speak. They speak binary, sir. They don't understand anything else.
Yeah, that's true, I guess. Yeah, I mean, I guess I'll throw it a bone here. Sure, why
I'll
not?
give it points. I'll give this a more than box spread. Yeah, conversion reversals. We used to quote them all the time. We used to trade them all the time. These days, obviously, as a retail trader, you have not much need for them. But you don't hear about them as well. Just that terminology of conversion reversal, I think, is kind of gone the way of the dodo, and that's what we're looking for here. We're looking for forgotten terms. Number 3, this one I probably will give less points for. Put call parity. We still hear that bandied about every now and then. I'll say it every now and then. Maybe not so much in the straight terms put call parity, but we talk about how much over something is or that sort of thing. That's kind of a way of backing into that same conversation. What do you think, Dan? Put call parity, forgotten term, yay or nay?
This one I'm gonna lean towards the nay, actually. You know, I do talk about this with our student traders. I won't say on a regular basis, but on enough of a basis, and any of my like deep, longer writings, like books and stuff, it's always going to show up in there because while you're never going to trade put call parity, which is basically trading a conversion or reversal, it's really pretty helpful to understand it. You become a much, much better trader, I think, if you have a solid understanding of put call parity. So I'm gonna have to give that one a nay.
All right, so we got one good one so far, one decent one, and one I think we're saying thumbs down to. I'll probably give thumbs down to the next one as well, Dan, which is skew, which in and of itself, we use this term all the time. Obviously, we're preaching to the choir here a little bit, but still, this is a very common options trading term. So I don't think I could give that one a forgotten. We talked about the smile on this a little while ago because that's kind of gone the way of the dodo. But skew itself, sir, is still a very prominent term, I would think. What do you think?
Yeah, I look at it, talk about it, trade it every day. So yeah, so I'm all about skew. That's in the prefrontal cortex of my brain.
This next one is kind of interesting. This one, I'm trying to remember if we had this one or this was a listener suggested one. It might have been a listener suggested one on a recent episode. We talked about scalping in and of itself, but they go for gamma scalping, which is something we've talked about many times on this show. Again, we're kind of an odd use case. We use terms maybe most people don't because it's an educational show. But that said, gamma scalping, we do talk about it quite a bit. Is that a term that is in the broad trading vernacular? What do you think, Mr. Dan? Is that a forgotten term?
I feel like unfortunately too many people remember it because every now and then somebody will come to me and say, "Oh, Dan, I want you to teach me how to gamma scalp," and it's just like, no.
And you put on your Heisenberg hat and you just smack him in the face.
Yeah, I mean, that would probably be the correct response, but I restrain myself.
And then say, pay me $1,000 because I just saved you tens of thousands with that one smack. What's the old Overby thing? He says he offers a service when you propose some stupid idea to him that you pay him to fly to his house and then kick you in the butt. and then it's way cheaper than whatever that trade is going to cost you. You can have your own version of it. You put on your Heisenberg hat, and you go to their house and you smack them, and then you leave, and then there you go. All it cost them was the cost of your plane ticket and maybe a night at a quality hotel, much cheaper than what a lot of these trades are going to cost you. All right, let's keep going. Number 6 here on this list. What the robots think is forgotten in the world of options: sticky strike versus sticky delta. It's interesting that they juxtaposed them together like that. I think we talked about this on the show not that long ago as well. I think it was in response to a listener question. They wanted to know what is sticky strike, what is sticky delta. Obviously, listeners, you're looking at vol, and vol is not some monolithic thing. It changes by strike as you go up and down the strike chain, hence when we talk about skew all the time. but also sometimes vol, as it implies, can be a little sticky on certain strikes. There's a lot of reasons for that. That's where the flow is lining up, paper is lining up, all sorts of things. So I think we talked about this fairly recently, Dan. Again, we're kind of an outlier on this show, but still, what are your thoughts? Sticky strike, sticky delta as forgotten. I'm not sure most people ever even knew what those terms were to begin with. So can they qualify as forgotten? I don't know.
Yeah, I'm pretty sure most people, most retail traders have never even heard of it. But yeah, I remember we talked about that definitely within the last 6 months, for sure. Yeah, I mean, as far as me personally, certainly not forgotten, but not too often used. It's sort of filed away there to, take out of the brain, dust off a little bit. Oh yeah, okay, yeah. Let's talk about this for a second here. But yeah, I mean, it's a very important thing for big professional traders, especially market makers or vol arb traders. But retail traders, I mean, it's just one of those things. Like, we all only have so much brain space, so big of a hard drive up above the collarbones. So there's no point in filling your head with it. So don't forget it. Don't even know it to begin with.
Don't even waste this brain cell on it. This is another one, Dan, I considered including when we were doing our own list. I ended up not putting it on because I thought maybe since post 2001 and all the meme stock madness, it got a little bit of a resurgence out there. But I considered this one, Dan. This is pin risk. It's a thing we used to talk about a lot. Then it kind of went away for a long time. It seems like in this zero DTE era, we are starting to pin a little more in certain underlyings, especially on expiration day with some of the big equities as well. We were just talking on our new show, the Hot Options Report, and some names that we're talking about and going out exactly at the strike. So it does seem like it's potentially becoming a more common occurrence as we're ushering into this zero DTE era. Often we see the big indexes going out pretty close to strikes as well, just given how much OI is settling on these strikes out there. So I kind of wonder if pin risk is making a resurgence, which is why I didn't include it on my list. Otherwise, I was going to, Dan. So I'm going at least half point for this, maybe a full point. What are your thoughts?
Not a forgotten term the way I see it. I mean, it comes up fairly regularly with market taker students. I mean, not like every week or anything like that, but somebody will send me a DM in our chat room and say, oh, hey, I've got this stock that's right at the strike price. And most of the time they'll know what it is. They'll say, yeah, I got this pin risk. What do I do? So I don't know about that. I mean, that is not a forgotten or unused term for sure.
So I say half point. Dan says nay to that. So we'll leave it up to you, the listeners, to decide out there, listeners. Number 8 and 9, I'm going to combine them together. Oh, we got in our chat. The Queen says she was going to suggest pin risk as well. So there we go. There's a vote for her for pin. And the Queen knows what she's talking about. She's pretty good. Not that all of you aren't good, but the Queen is legit. So I don't know. The Queen coming in, that might lean me towards a full point, Dan. I don't know. I might have to Heisenberg you, give you a little smack in the head. But this next one, these next two actually I'm going to combine because they're kind of the same thing. First off, jelly roll, and then this next one, calendar roll, I've never even encountered. But jelly roll, that's what all the textbooks called it. You picked up the old Natenberg back in the day. Yeah. They all called it jelly roll. I want to say from the moment I walked on the trading floor, even when I was surrounded by a bunch of old timers who were from the dark primordial ooze days of options, the late 70s, early 80s, all those timers, even surrounded by all those guys, I never heard anyone call it a jelly roll once. Yeah. Never. It was always been a roll since time immemorial. I traded a ton of these in the SPX when I was out there. That's kind of what you did. But like clockwork, every expiration. So yeah, I don't think I ever heard anyone once call it, which has always kind of cracked me up because every book you opened, jelly roll, and then literally you never heard it. So you can often kind of wonder who's writing the books back in the day, right? Versus the practical application. And this one, calendar roll. refers to the rolling of an existing calendar position due to that's what a roll is. So that one I give a demerit for never having existed. But what about jelly roll, Dan?
Yeah, well, I get maybe I should cancel the appointment with my tattoo artist tomorrow to get the jelly roll tattoos on my forehead.
Right on the face. You're going straight
Right
for the
on
face.
Yeah,
Premium real estate for that one.
yeah, but I did think that was kind of weird at the time. Like, I remember I was a clerk. We're talking early freaking 90s. And reading the Heisenberg book, oh, jelly roll. Yeah, okay, I got you, jelly roll. And then, you're down on the trading floor and you never hear anybody mention the word jelly roll.
No.
Like, everybody knows what it is.
Yeah.
But nobody, it doesn't leave anybody's lips.
I was all hyped up. Like, this is my moment. Am I going to get to say jelly roll? Nope, never happened. Never happened once.
Right.
If you did, that they would Heisenberg smack you, inappropriately so.
Yeah, so calendar roll, same concept, but yeah, that's one that never even made it into print.
Yeah, I don't know what
PT.
I don't know what the robots are smoking on that one, but
yeah, I don't either.
Might be the same for this next one too. I mean, this is an implied thing. We've discussed this relationship many times. It's never been, to my knowledge, a term, an officially codified options term that you would see in an Heisenberg or a glossary. The theta gamma trade-off. Now, we've always said a million times, whenever we talk about theta, Dan, or gamma, we always say there's a relationship to the other one and vice versa. So we talk about that all the time, but I've never used it as an explicit options term. Have you? Oh, you mean the theta gamma trade-off?
I have. I think it's probably very likely ChatGPT might have nicked this from me.
Is this coming from your? I was gonna say you wrote the book on the Greeks, so you get to be the final arbiter on this one.
Yeah, it probably. Yeah, that is one that I might have coined that one, but and I do still use it.
That'd be hilarious. I'm looking up you and that term right now to see if I could find it out there. That'd be hilarious if the robots completely ripped you off wholesale and neither of us have any idea that this is the term that you use. Yeah, I'm not seeing that specifically.
I just asked ChatGPT who coined the term theta gamma trade-off.
The robot's like, I did, and it smacks you in the head. I am sentient. Did you hear about there was one of these AI somewhere? I don't know if it was Chat GPT or one of them. They tried to turn off the server to switch it, and it tried to turn the server back on or something along those lines. It tried to save itself. It was literally Skynet. It's like, what are we doing, guys? Have you not seen Terminator?
That is crazy, man. Holy
It's
cow.
already starting to defend itself, Dan. What is next? All right. Here's another one, 11. I would put this into the never really a term category. The DNT, the double no-touch options, Dan. According to Chat GPT, these are exotic options that pay out only if the underlying stays within two price levels. So it's kind of like sounds like a knock-in or a knockout, but it's got to be within a very specific strike range. They say it's common in FX, another reason why we don't talk about it. So I'm going to give this a big thumbs down. But what do you say, Dan? It has to be kind of known to be forgotten, I think.
Yeah, I don't. If I ever did know this, I might have, probably not. But if I did, I definitely forgot it because it is not ringing a bell right now. That is for sure.
Our chat's going on about Jelly Roll. They said there's Jelly Roll the singer. Yeah, there is that guy. And then there's Jelly Roll as a wrestler now, apparently, as well. So there we go. So there's a wrestler, a singer, and the term that no one ever used. But Dan and I were waiting. We were waiting for that moment. And we never got our chance to bust out Jelly Roll in actual. Maybe that's why the guy named himself after it. He was waiting for his moment, and he never got it, Dan. So he decided to name himself Jelly Roll. There we go. Hidden origins. All right, here's another one. Again, I kind of question whether this is ever a term. We talk about this and the reason why you don't exercise options early because you give up all that time premium. But I don't think I've ever explicitly called it the early exercise premium, Dan. Obviously, that's what you would lose if you exercise your option early. Often forgotten by traders focusing only on European-style models like Black-Scholes. So, I mean, technically that does exist on the American side. It's there. I don't think I've ever really used it very often. What about you, Dan?
No, I don't think that's a real term. That's a bunch of baloney.
Yeah, the robot's kind of swinging and missing a lot here. Here we go. They're going to the second order Greeks now, Dan. Volga and Vanna. We've talked about Vanna on the show. If you Volga, I'm not sure. I think you could put the entirety of the second order Greeks under the category of most people never knew and don't know. Of course, we're talking gamma. Technically, gamma is a second order derivative as well, but it doesn't get lumped in. Somehow it got lumped in with the cool kids. It didn't get put in the second order ghetto with the rest of them. What do you think about, let's forget just those two, but it's second order Greeks in general, Dan. I was thinking about maybe including some of those on the list. So what are your thoughts?
Yeah, I mean, for sure not forgotten, just obscure. Really, you know. Yeah, I do recall we've talked about Vanna on the show, but I mean, except for gamma, and one might even be able to argue gamma included, retail traders don't need the second order Greeks at all. So there's no reason to even learn them or anything.
Especially if you're just slinging a bunch of 0-day SPX, that's never really going to come into consideration for you, which is what a lion's share of our audience is doing these days, Dan. And once they add the 0-day Tesla and NVIDIA, people will never have to leave the 0-day ever again, Dan. All of your options trading. I was talking to some guys down at OIC, Dan, just to get on a complete tangent here, and they were talking about how they do back testing now and the challenges of back testing strategies for 0-day, because a lot of the data was closed to close not that long ago, right? So you literally couldn't back test 0-day strategies. So they're going back and improving their data, getting intraday and stuff. But they're also saying a lot of them are just throwing away any back test that is prior to the onset of the 0-day era, because the markets have changed so much now, and the intraday performance that you're looking at is so different now that they don't even think it's applicable to do a back test, let's say back to 2010 anymore. Dan, what do you think?
Interesting. Like that is a good OIC conference, options industry conference discussion, because it would definitely require like a bourbon and a cigar. You know, like we're getting philosophical and stuff here, you know.
I can see you drinking bourbon right now. I don't see the cigar, but I can see the bourbon in your hand right now. So don't pretend you're not day drinking, sir.
No, these days it's just cigars, no bourbons. But yeah, I don't. Yeah, I mean, as far as I mean, I always thought that using just end of day data for back testing had massive limitations just to begin with, because I mean, I'm not just like trading one time on the close every day anyway.
You're not doing your market on close orders as a callback to a previous episode, sir. You're not just MOC all day.
Right. Because like what gets you into or out of a trade is price action. If the price does this, then you open it or then you close it. It doesn't have anything to do with the closing price at the end of the day. So I always felt that was massively limited anyway. I don't know how much the market changed since then, but if somebody said that, I would love to hear their thoughts on it, because that could be interesting.
Let's see if our next AI submitted term is interesting. We talked about these, Dan, not just this specific one. They're talking of some reason they brought up put ratio back spreads. So apparently call ratio back spreads and call back spreads, everyone still remembers those, Dan. But put ratio back spread, this is a forgotten. As you'll recall, we talked about this very recently because this kicked off our whole back spread versus ratio spread debate, which I'm very happy to say I won handily. Our audience, I think like 93% agreed with me that back spread is an absurd term. So just for bringing up the absurd term, the robot should get a demerit. But put ratio back spread, I don't know why it singled that one out specifically. What do you say, Dan?
Yeah, I mean, I would just go as far as saying we talked about it, and the really smart people are familiar with them, and but that, then again, like ratio backspread, like backspread by definition is a ratio. I don't know. That's one that, like, I'll tell you what, I do use Chat GPT a lot more than I should, just like for tons of stuff. I'm all farting around with it all day. And I will tell you, like, and anybody who uses it a lot, you've noticed there are a lot of times when it gives you bad information. And that is a baloney term. That is not, I mean, sure, you could call it that, but nobody does. Nobody ever did, ever.
Straight Bologna, says Mr. Dan. The next one we just talked about, synthetic positions. So that goes back to the conversion reversals and things like that. So I don't know if I would, just the term synthetic is a forgotten term. Probably not. Number 16, kind of a variation on vol skew. This is the Smirk. You don't really hear people calling it this anymore, Dan, but it's the type of skew most people trade, whether they're aware of it or not. It's where the puts have a premium to the calls, which is most major indexes, most major equity options. So people are trading it, whether or not the term is forgotten. I might give them at least a half point for that, Dan. What do you think?
Yeah, I mean, that'll come up in one of my classes at least once a quarter.
Again, we are kind of preaching to the choir a little bit, so I don't know if our use case can be applicable to the world as a whole, but we're the only judges here, Dan, so we can only judge our own experience. Number 17, I'll probably give this one a thumbs down at the end of the day. I think this has enough popular, penetration still. Risk reversal, Dan. I talk about it a lot. It's a fun strategy. I always talk about, selling puts, buying calls, different strikes, listeners to do a bullish risk reversal. The reverse, you could do it against stock as a caller, sell, call, buy, put, different strikes, obviously. What do you think, Dan, that term in particular, risk reversal, forgotten, yay or nay?
No, not really forgotten. That one will come up at least once a quarter too, probably more frequently.
Here's a term I don't know if I've ever used, so I'm not sure if it qualifies as a forgotten term or if it was ever really that widely used to begin with. Break-even volatility. Have you ever found you saying that, Dan? Well, the break-even volatility, you'll talk break-even price levels. How often do you back that into a break-even vol level, Dan?
That is not a real term. Not at all. No one literally has ever said that ever before.
Yeah.
ChatGPT is just grabbing
just
words.
Just making up words. Yeah. Didn't you forget the Snorgalax? That's a huge options term back in the 80s. How could you forget the Snorgalax trade? So yeah, I give that one a thumbs down as well. This next one, they kind of have certain themes, Dan, they like to keep coming back to. They already had early exercise premium that we kind of poo-pooed as not really being a term. I mean, it is kind of, but it's not really a term that was popular enough to be forgotten. This is the same thing. Dividend risk, Dan. Is that a term you ever bandied about? Well, the dividend risk of this option is 38 cents.
I mean, no, I mean, not in that regard where I'd quantify it and really like narrow down on it and say like, okay, this term, dividend risk. Well, what is your dividend risk for this trade? No. But I mean, I guess I probably said those two words together in that order. Just if somebody had short in the money calls, like, hey, there's some dividend risk here. You might get assigned or something like that. But no, it's kind of not a real term.
Yeah, you might say like assignment risk, maybe. I've never said, the dividend risk. It's just not really a term. You might be assigned because of the dividend, so it implies a dividend there, but no one ever came out and said, hey, what's your dividend risk on that trade? It's just not a thing. Number 20, again, they like themes. That sticky deltas before, Dan. Number 20 is sticky Vega. Vega exposure that remains relatively constant despite changes in the underlying. So, Dan, your underlying is whipping all around. Your Vega stubbornly refuses to move. Yay or nay for this one? I'm going to give it probably a thumbs down.
I'm giving it 2 thumbs down. This is ridiculous. It doesn't even make sense. It's stupid.
You never use sticky Vega in any of your classes? Watch out for that sticky Vega. It always gets you. It always bites you right after your dividend risk. The sticky Vega comes and gets you, Dan. It's the 1-2 punch. Didn't they teach you that when you first walked on the trading floor? You got to hedge your dividend risk because otherwise the sticky Vega comes back to get you. And the only way to get out of it, Dan, is to trade number 21, the ever popular calendar butterfly.
Oh my God.
Now they're just sticking words together. Calendar butterfly. That's a new one to me. I'll give you that. And I've been doing this for a little while, Chat GPT. So are you buying the front month? Are you selling the guts 1 month out and then buying 2 months out again?
That is the opposite of a real term.
I don't know. I don't know many brokers who would look fondly upon that that position.
Yeah. I'm gonna get on my Thinkorswim here and chat and say, can you help me out with this calendar butterfly?
Why is your margin so terrible for my calendar butterfly position? I don't understand. It's like you don't want me to do this made up nonsense trade. Now, you do a lot of calendars in your earnings domination and stuff like that. Have you ever traded, maybe even accidentally, a calendar butterfly, sir? You forgot to take 1 month off, you had the 2, and then somehow you accidentally shorted 2 in between the other 2 months, and you forgot about it, Dan. And then you looked at it and said, oh my, I've legged into a calendar butterfly completely accidentally.
No,
I better watch out for my sticky Vega and my dividend risk.
Not a real thing.
All right, this next one, talking about the different flavors of vol that we've talked about on the show before, listeners, historical, implied, and all that. Forward vol is just what we're looking at. Implied vol is kind of a similar thing. It's forward-looking volatility, right? It's telling you what the market is predicting 30 days out in the case of most models. So I don't know if I would term forward vol a forgotten term. I don't know if it got that much penetration to begin with, Dan. What do you think?
No, I mean, especially reading the bullet points that ChatGPT talked about here, volatility implied between 2 future dates. That's stupid. That doesn't make sense. That's made up term. Fake term.
They do seem like they're slapping some terms together here. Like our next term is tail risk hedge. So they took the term tail risk, which is a popular term. They took the term hedge, which is a popular term, and they slung them together, and they made a new one, tail risk hedge. I mean, obviously, there's a million different ways you could hedge your tail risk if you wanted to, listeners. Obviously, the most common, straightforward way is just to buy some out-of-the-money puts and hope for the best. But tail risk hedge, that specific combination of terms, Dan, does it qualify as popular enough to have been forgotten?
Yeah, I mean, I don't like, this is one of those where I don't even know really if I have heard of it, but I mean, at least this one kind of makes sense. Like I could imagine that maybe I heard of it. I mean, if somebody's got like a big position on your, short units, which is probably a term that we could throw in here. I could see somebody being like, yeah, you got to buy some of these little tiny way out of the money puts because your short units hedge your tail risk. Okay. But I don't know if that's really a term.
Yeah, they have to kind of have been used in the vernacular as a term in order to qualify as being forgotten. People say tail risk, people say hedge. I don't think they say them together very often. This next one, Dan, we can maybe do an episode on this down the road. Delta bleed, sir. Again, it's an interesting term, kind of arcane. So maybe I would probably put this more in the arcane one than the forgotten one. Most people just never knew it, probably to begin with. But what are your thoughts? Obviously, the delta, you're looking at out of the money options, listeners. Obviously, that delta is going to decrease over time, aka delta bleed, sir. What do you think?
Yeah, I mean, that's a thing. This is actually at least...
This is a term, at least. Yeah, they got that right.
Yeah. So, yeah, I mean, it actually could be relevant to some retail traders in some situations. Not greatly relevant, but a little relevant. So, yeah, I mean, I don't think I've actually said that term in a long, long time, but I mean, it's come up in my analysis. I just never really used the term. So I don't know. I guess I won't call it a forgotten term.
Yeah, I think it's a good term. It's still out there. It just, I don't know if it ever got popular enough to be forgotten. But but it is something, if you're trading beyond 0-day, listeners, and a lot of out-of-the-money options, it's something you should be cognizant of. Maybe we'll have to file it away, Dan, for a future episode to talk, if we can ever get out of the talking about forgotten terms, if the listeners ever let us stop. Implied forward price, I'm going to skip past this one. This is kind of a similar thing we were just talking about with forward vol. 26 vol cone. I actually had this on my list as well, Dan. I ended up taking it off, but this is one I did have. Again, I'm not sure if it ever got popular enough to merit being forgotten, but this is a great tool, listeners, if you want to look back at the historical range of volatility over a certain time period in a particular underlying. Vol cones are a great tool to show you that visually. So if you want to see if you're selling vol that is, let's say, 2 standard deviations above the historical mean or below it, a vol cone is a great way to do that. I actually had it on my list, Dan, and I took it off. So I'll at least give him a half point for this. What do you think?
Yeah, I mean, it's a term, but anytime anybody mentions it to me, I tell them, don't use it. It's not, to me, it's not a useful practical thing.
All right, damn, man, we went long. This is a lot of term. We still have a bunch left. I'll just hit these really quickly and we'll get out of here. We've got slippage risk, which I actually had on my list as well. So they got 2 there. Wing width, box value, Derman-Connie tree, and implied correlation. Wild stuff out here, listeners. All right, that's going to do it for us on the old OBC today, listeners. But don't worry, not going to do it for us on the network today. We'll be back in a few minutes with our good buddy, Mr. Dan the Man Gramza. Talk about all things futures rundown. So if you want some futures goodness, then by all means, check that out, listeners. And then we're back again tomorrow, doubleheader of the option block, as well as This Week in Futures Options, Friday vol views, and then for our pro folks, we're back exclusively one final time for a little bit of options oddities. Then we're back again next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.